Last week we talked about Graham's definition of investment and how that applies in this class. And we said we're talking about safety of principle, which is one of his major pillars of his investment philosophy. And we said the way he gets safety of principle is by buying quality blue chip stocks at a reasonable price. Okay. And he does not try to predict the future. He does not try to say, what's the latest technology coming out? What's the next drug breakthrough coming out? What's the next product that's going to revolutionize? That's not what he's looking for. That's not how he invests. What he invests is he just says, I'm going to buy good quality companies. Over time, they must go up. Now, how can he say that? How can we say that over time these stocks must go up? And if you did your homework, and when we look at their earnings over the last 10 years, did you notice that pretty much every stock that's large, prominent, conservatively financed with good credit has positive earnings over the last 10 years? And generally growing? Most of the stocks that we look at, when we look at their 10-year earnings, they're positive and they're generally growing. And if you think about what's been going on in the last 10 years, well, 10 years ago, started with an attack on the Twin Towers, right? Which led to a recession and a war. And after that recession, we came out, they called it the jobless recovery. Then there was the housing bubble, which burst, which created the credit crisis that we're still in to this day. I mean, it's lingering worldwide, right? And so you think the last 10 years haven't been a phenomenal time to invest. And I don't think anyone will argue with me. We say the last two presidents that have been in charge of the country weren't fiscal geniuses. I mean, I don't think a Democrat or a Republican will argue too much with me on that. And yet, these companies that are large, prominent, conservatively financed with good credit and solid earnings have all been growing their earnings. Aren't they watching the news? And I would suggest to you that they're going to continue to grow their earnings. And I'm going to tell you why, okay? What we do when we do our thorough analysis, we look at the company's income statement and we look at their balance sheet. On the income statement is income expenses. On the balance sheet is assets. I better not abbreviate that. And liabilities. Okay? And we look for companies that have solid earnings. Let me turn that off. We look for companies that have solid earnings, enough earnings to pay a dividend and some more, right? And to cover that dividend. So that's their income. And what could they do with that money that they make? Well, they could spend it, right? That's like paying a dividend. They pay that money out to their investors so they could spend it. Or they could pay down their liabilities, pay down their debts, buy back their stock, which GameStop just did. Or they could buy more assets. They could hire more people, buy more equipment, build a new plant, buy another company. Those are the three things that they can do with their income. And because they have solid income. Now let me give you an example of, say, an individual. This works equally well for an individual or for a corporation. Let's say this guy's worked at the bank for 30 years, right? He's done nothing spectacular. He was a teller when he started. 30 years later, he's still a teller, right? He's done nothing spectacular at the bank, but he hasn't gotten fired. That's the only really thing to his credit. And let's say he makes $1,000 a paycheck, whatever that is, weekly, monthly, 2 weeks. But the one thing he does is he spends less than he makes. Okay. So his net income is $200. And what does he do with that? He spends some of it. With some of it, he pays down his debts. And with some of it, he buys more assets. What kind of assets does he buy? Who cares? CD, bond, mutual funds, whatever he buys. But let's define a couple of terms real quick. An asset, for our purposes, is something which generates an income. So by that definition, is your house an asset? No, it doesn't generate it. What if you had a rental house? Would that be an asset? What if you had a vacation house? Depends whether you rent it or not. Depends whether you rent it. That's exactly right. If it generates an income, it's an asset. If not, it is not. So what is a liability? A liability is something that generates an expense. right? Like a boat. It generates a payment, it generates a slip rental, it generates maintenance expenses. You know, it generates expenses, okay? So what he's doing, number one, he spends less than he makes. Number two, he pays down his liabilities. And number three, he buys more assets. I'm going to tell you that his earnings must grow over time, and his book value or his net worth must grow over time. If he never gets a promotion, if he never becomes ops manager, if he never becomes branch manager, if he never becomes a loan officer, all he does is just be a teller. As long as he doesn't get fired and he spends less than he makes, guess what? Over time, his net income is going to go up. Why? Because a few years later, he's been paying down his liabilities, right? A few years later, his expenses, which are a function of his liabilities, let's say they're down to 700, right? He's been paying down his debts. His assets, which generate an income, are now generating an income. Okay, he gets dividends on his CDs, on his bonds, on his mutual funds. So now his income's 1,100. His expenses are 700. So now he makes 400. His earnings just went up, right? By the same token, his liabilities are coming down. His assets are going up. His net worth is going up. Just because he has solid earnings, he spends less than he makes, he pays down his liabilities, and he buys more assets. That's the same thing for the corporations that we buy. We buy good, quality, blue chip companies that have solid earnings, that are covering their dividend. Right? That's why we look at that coverage number, right? We're making sure that their debt ratios, they're keeping them in check, and they're buying more assets. Because of that, their book value, BV, must go up over time. Because of that, their earnings must go up over time. And if we buy them at reasonable multiples to earnings and reasonable multiples to book value, our stock must go up over time. It must. It must. That's why we don't have to watch the news so closely, because we buy good quality companies. The only real big risk here is if they buy toxic assets, like Bank of America, right? They bought Countrywide, they bought Merrill Lynch, whose balance sheets were loaded up with toxic assets. Then their book value went down, right? But if they avoid that, they must grow their book value over time, and they must grow their earnings over time, okay?
What about a buggy whip manufacturer, for example? You know, again, of 100 years ago. I mean,
He talks about that, yeah. Because if they have enough cash on their balance sheet, they're going to find something else to do with it. That's why we have Hewlett-Packard in the portfolio. We're not too worried about it. Everyone's talking about the death of the PC. But guess what? Their balance sheet is so strong, their debt is so low, that they're going to have to do something with that money. They're going to buy more assets. They're going to buy another company. And those buggy whip companies that had a good balance sheet, they became something else. And it's real popular. Like Berkshire Hathaway is nothing like what it, yeah, 3M. They became something else because they're going to buy more assets. Okay? As an individual it works, and as a corporation it works. And that's the funny thing. Individuals mess up too by buying more assets. They get to a point where they're making good money and they're having a comfortable balance sheet, and then they start taking risks in real estate. They start speculating in real estate instead of investing in real estate, or they speculate in the stock market, or they start a new business. And you see people that was their one downfall, right? So as long as we're good at not buying toxic assets, and that's what we're going to show you how to do, you can apply this to your portfolio, but you can apply it to your own financial statements. Spend less than you make, pay down your liabilities, and buy your assets. So does that make sense why it's so important to start out with buying a good quality blue chip company and not paying too much for it? The rest kind of takes care of itself.